Your next reading is Portfolio Management and Overview, and these are the specific learning outcome statements. The first always says describe the portfolio approach to investing. It's very straightforward. I'm sure you would have heard that famous cliche that do not put all your eggs in one basket. If you do, if the basket tumbles, you will lose all your eggs. Then what you should do, you should diversify your investment this way. Just let's say this was just a single asset and you invested all your money in the single asset. Now what you can do, instead of just putting money in the single basket, you can put some in T-bills, some in cash, some in international bonds, commodities, real estate bonds. This is what you call diversification. This is what you call portfolio, collection of investment in different assets. So this would diversify. This would result in reduction in the overall risk. That's what you call the portfolio approach to investing. Let us discuss this further. There are broadly two main categories of risk. Specific risks. These are the risks that affect a particular company or a particular industry or a line of business. For example, the risk of employees going on a strike, or there may be problems of supply of raw materials, problem of availability of services. So specific risks, sometimes also called the unsystematic risks, they are specific to a particular asset or a particular company. But systematic risks, these are the risks which affect the market as a whole. For example, if the interest rate changes, it will affect all the businesses that have exposure on interest rate. If the rate of inflation changes, it will affect the cost of input, or the threat of war, political risk, legal risk. There are many risks that affect many businesses, the whole of the economy. So these specific risks, they can be diversified, but systematic risks, also called undiversifiable risk, it cannot be reduced by diversification. Let us take this example here. Now let us say you plot number of assets in the portfolio on the x-axis and portfolio risk on the y-axis. If you just hold one asset, you will be exposed to a higher level of risk. But when we combine 2 or 3 assets which have negative correlation with each other with regard to returns, the risk will start falling. The specific risks are eliminated by diversification. So as you keep on adding the assets in the portfolio, the risk that you are able to reduce are called the specific risks or diversifiable risk or unsystematic risks, right? So you keep on doing that up to 18, 19, 20. The 20 assets are added, you will be able to lower this unsystematic risks to this point, as if it's going parallel to this line. A point will come where further diversification will not lower the risk. Risk cannot further be reduced by diversification. This is the risk that doesn't go away, is called the systematic risk. Undiversifiable market risk or systematic risk, right? So number of assets in a portfolio, when they increase, so the negatively correlated return, they tend to cancel each other out. So the total risk can be reduced through diversification. So that is the idea of portfolio approach to investing. As we increase the number of assets in the portfolio which have negative correlation with each other, this way the overall portfolio risk can be reduced. Next, LOS says describe the steps in the portfolio management process. There are 3 main steps, and which are further subdivided into multiple sub-steps. First step is planning. Planning involves understanding the client's needs, what the client wants. It involves establishing the client's objectives and the client's constraints. It answers the question, what does the client want? This is in the planning step. Then preparation of an investment policy statement. What is an investment policy statement, also called IPS? IPS basically is a written document describing all the investment objectives and constraints that apply to a client portfolio. So basically, client needs are put in writing. It may specify anything like return goal for the client is 10% and that the client requires a regular updation. So this is the first step. The second step is execution. In the execution step, we as analysts, we identify asset allocation. We identify assets in which to invest. It may include stocks, bonds, real estate, cash, and at this point we establish the weightages according to which we will invest in different assets. Then within this sub-step is security analysis. We, the analysts, will extensively analyze individual assets within the class. Each asset is assessed for risk and cash flows. So by valuing each asset, preferred investments can be identified. And then within this, the last sub-step is portfolio construction. So using the investment policy statement IPS, the desired asset allocation and security analysis, a diversified portfolio can be constructed. So that completes your second step. The third is feedback. Portfolio balancing and monitoring. So after the portfolio has been constructed at this point, portfolio construction in the second step and third sub-step. After the portfolio has been constructed, it needs to be reviewed and monitored at an appropriate interval. So rebalancing involves buying and selling decisions to restore the targeted asset allocation after the market movement. If the market moves up and down, so we may have to buy or sell certain assets so as to keep the targeted weightages in our portfolio. Then performance measurement and reporting. This is a very crucial step, the last sub-step in these three steps. In this step, the portfolio performance must be evaluated to establish whether the client's objectives have been met. Performance may be screened against the benchmark specified in the IPS, whatever we have set here as the benchmark to gauge the performance. So performance may be assessed against the benchmark that we would have specified in IPS. So whether step 1 and 2 need to be revisited, the planning and execution, they may be requiring some revision. So whether step 1 and step 2 need to be revisited depends on this result, the feedback. Then your next LO says describe types of investors and distinctive characteristics and needs of each. There are two main categories of investors: individual investors and the institutional investors. Individual investors, just like you and me, they may be investing for short-term or long-term goals. So a short-term goal could be education for children, or long-term goal could be the retirement income. Institutional investors, when we say institutional investors, we're talking about banks, insurance companies, mutual funds, investment companies, so on and so forth. So when you say banks pool deposits to issue loans like JP Morgan Chase. Insurance companies are also institutional investors. So what they do with their role is they accept various types of risks in return for premium. Like if I buy a vehicle insurance, so I pay a certain amount of premium to the insurance company. So insurance company will take that premium and invest it in different assets. So this way, the insurance company can further diversify its asset base so as to meet the claims of the policyholders. Then investment companies. Investment companies manage pool funds. They are also institutional investors. And then sovereign wealth funds. Sovereign wealth funds, they are government-owned investment funds. Some operate with the objective of investing the revenue from the natural resources of the country, like oil, gas, etc. Then we have described defined contribution and defined benefit pension plan. First, let's discuss defined contribution pension plan. Employees of both private and public companies, they often save and invest for retirement via defined contribution pension plan or defined benefit plans. So we are discussing first defined contribution plan. So what is defined contribution plan? Defined contribution plan basically it's an investment vehicle in which the amount invested or the contribution made is made by the employer and employee both. So objective of a defined contribution pension plan is to accumulate wealth by investing a portion of wages while working in order to provide income during retirement. Since the benefits of a defined contribution plan are not defined, the employee assumes the investment risk. Next, describe defined contribution and defined benefit pension plan. Well, defined benefit pension plan, in the defined benefit pension plan, the employer has an obligation to provide certain benefits to employees when they retire. It's different from the previous one. The future benefit is specified or defined, unlike the previous defined contribution plan. So it involves management that has to take into consideration the timing of its future liabilities or cash flows by assessing the age of its plan members, when they have to pay how much cash depending upon the age of the plan members. Then the payout. Payout is usually based on a member's average salary and the number of years worked with the organization. Okay, next LOS is describe aspects of asset management industry. So some key aspects of asset management industry. First of all, the firms or the managers in this industry, they are referred to as buy-side firms, in contrast to what we call the sell-side firms. Sell-side firms basically includes broker dealers and investment banks. So we have a category called full service asset managers. These are the managers that offer a variety of investment styles and asset classes. And then there are specialist asset managers. They may focus on a particular investment style or a particular asset class. And then we have a multi-boutique firms. So multi-boutique firm basically is a holding company that includes a number of different specialist asset managers. Then we have active management versus passive management. What is the difference? Active management attempts to outperform a chosen benchmark through manager skill. For example, by using fundamental or technical analysis, beating the market. That's what you say, active management. But in passive management, attempt is made to replicate the performance of a chosen benchmark index. Then we have some trends in asset management industry. The latest trends show that the passive management market share is increasing, maybe because of the lower fee charge. Now because of information technology development, amount of data available to the management has grown exponentially over the last few years. So more data available for analysis. This is an interesting application of technology, robo-advisors. So robo-advisors basically are technologies that can help investors make investment decisions. So basically they provide advice and recommendation based on their investment requirements and their constraints. So this is the use of technology in investment decision making. Then next LOS is describe mutual funds and compare them with other pooled investment products. So what are mutual funds? Mutual funds are simply a means of combining or pooling the funds of a large group of investors. I invest, you invest, A, B, C. They put their money in a single pool of investment. So this pooled investment is called a mutual fund. The buy and sell decisions from the fund, from the resources in the funds, they are made by the fund manager, and this fund manager is compensated for the service provided. Then remember, mutual funds, they seek relative returns. Means they have certain benchmark which they have to outperform. So they try to outperform a certain benchmark. And like many other financial intermediaries like banks, insurance companies, mutual funds are also a form of financial intermediaries. Then why are they so popular? First, if I have some money, I do not have investment skills, I can just simply put my money in mutual fund and the fund manager will take care of my money. So I can, instead of diversifying my investment myself, my investment can be managed by the fund manager who can use his professional skills to achieve diversification. So this is the first benefit diversification. It's misspelled here, but diversification, because full-time professional management is available to take care of your investment, and you just need a little amount of money to invest in the mutual fund. You don't need sizable investments to generate returns. Then the next part of this LOS is differentiate between open-end mutual fund and closed-end mutual fund. An open-end mutual fund basically is an investment company that stands ready to buy and sell shares in itself to investors at any time, buying and selling the shares in itself to others. Whereas a closed-end mutual fund, it's an investment company with a fixed number of shares that are bought and sold by investors only in the open market, not from the fund itself. Then the next difference is shares are worth their NAV. What is NAV basically? NAV is called net asset value. It's the value of the assets held by the mutual fund divided by the number of shares. So shares are worth their NAV because the fund stands ready to redeem their shares at any time. As you've seen, they buy and sell shares within itself. Whereas in closed-end mutual funds, share value may differ from their NAV. So they provide generally less income, but here closed-end mutual funds generally provide more income. That's the brief difference between these two. Then the next part says types of mutual funds. The first type is a money market mutual fund. Money market mutual fund, as the name suggests, specializing in the money market instruments. Then we have bond market funds. This is bond basically. Bond market mutual fund invest in individual bonds and occasionally preference shares. Then we have stock mutual funds. They invest in stock clearly. They can be actively managed or passively managed. We have discussed this previously. So a passive fund is simply designed to track a particular index through a buy and hold strategy, whereas an actively managed fund is comprised of equity securities selected by the portfolio manager, and that portfolio manager is seeking to outperform the market. And then we have hybrid or balanced funds. They invest in both equities and bonds. Then some other pooled investments. Exchange traded funds. An exchange traded fund or ETF is basically an index fund. It trades like a closed-end fund. So particular domain where ETFs seem to have an edge over the more traditional index fund is the more specialized indices. A well-known ETF is the Standard & Poor's Depository Receipt, or SPDR. It mimics the S&P 500 index, commonly called SPDR, and it has a management fee of 0.09%. And another well-known ETF mimics the Dow Jones. It's called the Diamond. And of course, there are many others as well. iShare, MSCI, Vanguard, FTSE Emerging Markets, Invesco, QQQ. Many indices are, many ETFs are there holding billions of dollars of assets under management. Then hedge funds we already discussed in our previous reading. Hedge funds, unlike mutual funds, which are long only mostly, because they make only buy-sell decisions. Hedge funds engage in more aggressive strategies and it takes more aggressive positions. Hedge funds, they seek absolute positive return. And as I said, they engage in aggressive strategies. When I say aggressive strategies, means they engage in short selling. And what is short selling? When an investor wants to profit if a security price declines. Trading in derivatives such as options, forwards, futures, and so on and so forth. So that ends your reading portfolio management and overview. This was just an overview. We'll discuss things in much more detail in the subsequent reading.